now we're going to look at short sales. And this is when you sell a stock that you do not own, and the term is to sell short. And you buy it back later in order to profit by hopefully buying it back at a lower price. And so here you are hoping to sell high and then buy low. And just quickly, the terminology: buy and sell are actions, and long and short are positions. So when we use this terminology, we buy 10 shares to go long. We were flat. We buy 10 shares to go long. If you tell your broker that you want to go short 10 shares, well, that means, let me think, you're long 10. If you want to go short 10, it means you have to sell 20. You sell 10 to go flat and then 10 more to go short. So again, buy and sell are actions, long and short are positions. Okay, so let's talk about the short sale mechanics, how you go about doing this. You must do it through a stock broker. And your broker borrows the stock in order to deliver these shares to the party that's buying the stock. The buyer doesn't know that you don't really own the stock, because the buyer becomes the new owner of record. And so the shares that you have borrowed are then delivered to the buyer, and then you actually owe the shares to the person from whom you borrowed it, and you actually have to pay interest on this borrowed stock over time. Later, you buy the stock from the market and you return it to the party from which you borrowed it to make whole. And this works because there is no use for holding stock. Right? I can borrow stock and then sell it, then if I don't own it, because the owner of the stock has no use for this stock. Right? You can't sell oil that you don't own, because people are going to want the oil so that they can refine it. And you can't sell wheat that you don't own, but you can sell stock that you don't own, because there is no actual use for a share of stock. And just to be clear, you can take a position in a derivative market in oil or wheat in which you profit when the price goes down. And sometimes this is referred to as being short, but you are not literally short the underlying asset the way you are in a stock trade. So a short position is a negative carry trade, which means over time it costs you money to be short. You must pay interest on the borrowed stock. In addition, while you are short, the rule is you have to pay all the dividends to the party from which you borrowed the stock. And you have to put up a margin. So we'll look at that. And again, we're going to look at two different kinds of examples. We're going to look at examples in which the stock price changes immediately. And again, examples when exactly 1 year passes. So let's do a quick example. We're going to look at a short position, and again, we're going to look at the balance sheet. It's a little more complicated now because of the borrowing of stock, and we'll look at another simple example. Here's the idea. I'm going to put $80 into my brokerage account again, and so nothing's happened. I've just put $80 in cash in the account. The equity is $80, and I'm going to sell short $100 worth of stock. And so again, for now, assume one share at $100. And so here's how this works. And it's a little confusing, so let's spend a second on this to make sure we get it. We're going to sell short 100 shares of stock. Therefore, we're going to get cash from the short sale of $100. In addition, we still have the $80 in margin cash. That hasn't gone anywhere. And so the total assets are $180. But the value of the stock that I owe is $100. And this is very important. I don't owe $100 in cash. I owe one share valued at $100. If the value of the stock changes, the value of what I owe changes. So again, I don't owe $100. I owe one share of stock, which is valued at $100. And it's a subtle but important point. And so my equity is going to be the 180 minus the 100, and that's $80 again. Oh, the equity hasn't changed. The short position margin, and this is a slightly different formula than we had before, now it's equity divided by the value of what's owed, not the value of what's held, because we don't hold anything. And so it's the 80 divided by the 100, and it's still 80% margin. So let's assume the stock price immediately decreases to $95. And again, it immediately decreases, so there's not going to be any interest paid or any interest owed or any dividends. It's going to be immediate. And it's a decrease to $95. Okay, let's see what the account looks like. And so now the asset, the cash from the short sale, hasn't changed because that's just cash. The margin cash hasn't changed. I still have $180 worth of equity. $180 worth of assets in the account. But my liability, what I owe, because I owe one share, is now $95. That has decreased. And so my equity used to be 180 minus 100 is 80. Now my equity is 180 minus 95 is 85. And so the stock return, the stock went from 100 to 95, so it went down 5%. But my equity went from 80 to 85, so I have a positive 6.25% return. Note that if I take the minus 5 divided by the 6.25, that is negative 80%. That's my short margin. My leverage ratio is the inverse of that. 6.25 divided by 5 is a negative 125, and I have negative leverage because I'm short. And the new short margin is the new equity value of 85 divided by the value of the stocks owed, which is 95, and my margin has gone from 80% to 89.47%. One important point is that if I enter into this trade and I look at my brokerage account, I'm not going to see any of this. I'm not going to see the cash from the short sale. Sorry, I apologize. I'm going to see everything else but the cash from the short sale. I'm going to see the margin cash that's in my account, but this does not show up. This cash from the short sale does not show up in my brokerage account list. We will include it so that we can correctly calculate the equity. But again, if I open up my brokerage account, this cash from short sale doesn't show up. The margin cash is there, and the $80, and on the other side, the value of what I owe is there, and the equity doesn't show. Just those two. And we're going to count this cash from short sale in order to be able to correctly calculate our equity and do the math that we need to do. Let's look at another short example, except now the stock price goes up. And so in the second example, I'm still going to deposit $80 into a brokerage account, and I'm going to sell short the $100 stock. But now, same position. So cash from the short sale is $100. I have the margin cash of 80 that I put up, and so the total assets is 180. The value of what I owe is 100, and so my equity is 80. And so the short position margin rate is where we were before, 80%. But now we're going to assume the stock price immediately increases to 120. Okay, so I'm short and the stock price went up. I'm going to lose money. Let's see how much money I lost. And so if the stock price goes to 120, here is where this shows up in the balance sheet because the value of what I owe has increased from 100 to 120. The asset side hasn't changed. The cash from short sale is still cash and the margin cash is still cash, and so the total assets is still 180. But now this has gone from 100 to 120, and so my equity has gone from 80 to 60. And so the stock return was plus 20%. My equity return was negative 25%. The stock return divided by the equity return, that's that negative short margin ratio. And the inverse again is that negative leverage ratio. And the new short position margin, that's going to be the equity value divided by the value of the stock. The equity divided by the value of the stock owed, that's going to be the 60 divided by 120. My margin rate is now 50%.